Well, welcome to Inside the Deal. I'm Trent Zeigler, your host, and this is where we break down how real operators are building, scaling, and closing deals in real estate today. Today, I'm joined by Stewart Heath, CPA and CEO founder of Harvard Grace Capital. Appreciate you being here today, Stewart.
Thank you so much for having me. It's quite the honor.
Yeah. So let's just dive right in here. For the viewers, Harvard Grace Capital, it says executive leadership and capital here. So what does somebody in your niche do at a high level?
Um, well, what Harvard Grace Capital does really, we've been on a journey for really since 2010. We started out doing fractional CFO work over the years, and we've transitioned out of that um, uh, really into a private equity real estate company. I'm a CPA, so I've always got my consulting hat on, and I'm always trying to help somebody, whenever I get into a conversation with them. That's just part of my being. But really, our focus today is acquiring, first class stabilized properties for the purpose of generating tax advantage cash flow back for the investors. It's a big mouthful, but when you boil it all down, it's an investment thesis that is really focused on the generation of cash flow versus doing new developments or anything like that. So,
Gotcha. Gotcha. Well, give me the quick backstory. How did you get where you are today?
yeah. Um, I became a CPA because my dad was a CPA, and I thought, well, okay. Uh, Love my dad, but we're really very, very, very different personalities. He was your classic CPA, stereotypical personality, green eye shades, and the whole bit. I've always been more like my mother, very entrepreneurial, lots of ideas all the time, and didn't really like working for other people because everybody else is stupid. I can do this better. So and so I have done that. I have been successful at working for and with other people many times as I've grown up and matured. But in my last transition, I went back to what I really love, and I started investing in real estate for myself back in 2000, and just started doing that on the side. And so when I got a chance to, go back to do that, I didn't want to do what I had done before, which was houses, duplexes, condos. I didn't want to do residential anymore.
Mhm.
At one point, I had a little over 200 residential units, and frankly, that was the nearest definition of hell on earth I could ever imagine. It was just I didn't like managing them. Um, I don't like being lied to on a daily basis. I mean, that's tough. It's a tough way to make your living. It's residential is good is good asset class for investment, but I've always managed everything we did, so I didn't like managing it. So when I got a chance to do it again, I wanted to do commercial, uh, but I didn't want to do multifamily, which is residential. And so started out doing suburban office buildings and then some storage. Really found my love in medical office buildings because doctors they don't move very often. It's very difficult for them. They usually put hundreds of thousands of dollars in their build out. So, and they're also not very price conscious. So, MOBs, you go back to COVID, and you may recall, the national media declared that office buildings were dead. Nobody's ever going back to the office. Well, okay, that's a big sweep with a big broom. There's about six fairly major subcategories of offices, medical being a very major one, and doctors didn't stay home. Um, they're not certainly not going remote, and they're not coming to see you. So it was just you've got to drill down into the data. So anyway, that's what we do. We go out and find great stabilized properties. I'm in the parking lot of one right now where we're doing an inspection today, and so it's our next acquisition. And if we can buy it right, that's the first thing you got to do. You got to buy it for the right price, and you have evaluated those tenants as good credits and good risks and stuff like that. Then the cash flow from it is reasonably predictable.
Mhm.
And when you buy it right, and then you follow on with a cost segregation study to maximize your depreciation balances, you can pretty much shelter the income from that uh, property for at least 3.5 years for your investors. And then your cash flow should grow every year after the first year. So we try to get it where you're going to get 7.5% cash on cash without regard to taxes. Most of that will be tax free because of depreciation. And then that 7.5 should grow to double digits within 3 years and then keep growing. And it's just a good, solid asset that throws off money. So I like to refer to real estate as God's asset class because he's the one that made all the real estate. So.
Right. Right. Um, well, zooming out, and thanks for your backstory there. Zooming out, talking about the industry a little bit. What major shifts are you seeing in the industry right now, if any? That can be local, it can be state, regional, national, whatever.
Yeah, I probably got a bit of both for you. So everybody's heard the expression "all real estate is local," uh, and that's true. It's so true. Um, I think it's becoming more true. And as we see our country politically and culturally um, segregate itself, and there's some pretty major population migrations going on. Um, so the markets have become highly more regionalized. In the South, virtually every city, small and large, has an influx of population going on right now. From all the southern states, including Texas and Florida and all that, and they're coming from the north, the east, the west. Um, and that's not to say that states like Arizona isn't receiving some of that, but where you've got population going, that creates more demand for the real estate that's there. It creates movements, more demand for housing, which translates into more demand for commercial shopping, groceries, restaurants, everything that goes along with that kind of thing. Um, but herein lies the problem. I mean, 20 years ago, it was just like, oh yeah, real estate's great. Generally the country was going along certain patterns. Can't really look at the country like that anymore. You got to look at the region. And the problem with that is that all real estate is local. Yes, we understand that, but all financing is global. So if I were doing an office building in Chicago, I'd be getting the exact same interest rate on that one as I am on the one I'm going to get here in Birmingham, Alabama. Uh, doesn't make a lot of sense to me, but that's the way it's kind of always been. It's somewhere akin to, we've got all the oil we need here in North America. Why is the price of oil going up for us when the problem's over there in the Middle East?
Mhm.
Because it's a global market, and you can agree with that or disagree with it. It is in fact that's what it is, and so it's kind of the way it is for financing. So financing interest rates dictate the price you can afford to pay for the property. If you're buying it right, if you're paying cash for your real estate, we need to have a sit down because you're making a mistake. I mean, and I'm not 100% debt guy or even a heavy debt guy. But if you're not using, 60 to 65% debt to acquire your properties, you're really leaving a lot of money on the table. But so but the availability of debt dictates what everybody's property is worth and what somebody else is willing to pay for it. So right now we see ourselves in in a flux period where interest rates are starting to tick back up. We ended the month of February with the 10-year Treasury at 3.9 something. It was below 4 for the first time in a long time. And that weekend, the war started. And so, gas went up, oil went up, interest rates started ticking back up. And this week they're thinking that it will hit 4.5 again. And 4.5 is kind of a magic number out there in the world. And if it hits 4.5, it might run on up and hit 5. And that makes banks recalibrate what they're able and willing to offer. And when the Treasury gets high, that makes interest rates, commercial interest rates even higher, which means you can't pay as much for a piece of property as you wanted,
Mhm.
or as the seller wants. So that's what I see going on in the world of real estate. It's always changing. Will that reverse when the war ends? I think it will. I don't think it's going to be like a light switch. I mean, our labor market and our everything in this country in our economy, it's really got pretty good strong numbers. Uh, the price of gas is too high, and that makes everything cost too much. So anyway, hope I answered your question there.
Yeah, I paid $120 for a full tank of gas yesterday. Crazy, crazy.
Wow, wow,
Um,
that
yeah.
is crazy.
All right. So, yeah, given all that in the industry, all the major shifts, and what you said about the interest rates, how has that impacted your business and your growth strategy?
Well, we're trying to pretty aggressively grow this year, and we've been negotiating on 18 or 20 different properties that are for sale and whatever, and uh, it's been very difficult. I'd call it a very balanced market, just real struggles between buyers and sellers right now, in that uh, the sellers want more than I'm willing to pay, and I think that they're unreasonable because they don't seem to realize where interest rates are. And so, out of these 18 properties, and we're still negotiating on several, I've only gotten one of them under contract so far. Still working on at least a half dozen. So um, the state of the economy has made things a little more difficult to get a good deal. So it's not always bad.
Yeah.
If there's a good balance between buyers and sellers, that probably means you're getting really to the right price. But some sellers are outside their minds. They and it always comes down to a cap rate, capitalization rate, which is nothing more than what ROI do you expect to get in the first year on that property, given the price that you're paying for it. So the cap rate is the net operating income divided by the purchase price, and so that results in a rate. And right now the going rates, what we like to pay is 7.5% or higher as a cap rate, which means the price is lower, and the sellers want to be somewhere in the sixes. Well, what you got to be mindful of, you can't go out and buy something at a 6 cap if your interest rate is 7.
Mhm.
You've got negative leverage, is what that's called, and you're basically losing money every day. Doesn't mean you will always lose money, but you're going to lose money that first year, likely, just until NOI catches up to where your financing is. So we like to flip that. I like to buy at a 7.5 or better, and right now I'm getting an interest rate at about 6.5. So I like to have a full point of positive leverage, which gives me margin, which actually adds to my as NOI grows over time, that margin just expands. So um, yeah, that might be a little bit more nerdy number stuff from the CPA here on the show today, but that's just how most real estate guys analyze it,
Mhm.
because real estate always does boil down to numbers. What's the income? What's the interest rate? And what are you paying for that stream of income? It's really just a financial transaction that comes with a nice piece of real estate. And it's very different it's very different in the world of development because you're making a lot more estimates, you're taking a lot more risk, and things can happen once you're in the deal that will change your outcome. So we don't do any of that. We're just focused on uh, really boring properties is what we like to call them. So
Yeah. The more boring, the better, right?
boring is beautiful is actually our motto. So
Yeah.
yeah.
Nice. Well, what's working well for you right now in your daily operations?
We've been able to expand our team. We do have our own property management operation, um, and just really got a good solid team all the way around. And so I hardly have to take any of those calls. I've done it all before. From changing, fixing toilets, whatnot, all the way up to crawling up on the roof. I don't have to do any of that anymore. I get to spend all of my time looking for the next properties to buy, negotiating, and things like that. So that's working really well for us. I do think sort of the stars are aligning. I think the second half of this year is just going to be really strong, and have an opportunity to get some really great properties at some generationally opportunistic prices. That's a long way of saying we're having fun right now. So most everything is going well. So
Well, good, good. That's good. Um, on the flip side of that, what's been frustrating in your day to day? Where you seeing friction at?
yeah, the most friction we have is what I've already described. Just a lot of sellers who just think their property is worth a whole lot more than the numbers dictate that it is. I can tell a story of a guy who owns a lot of property in Huntsville, Alabama. He's got some great properties, and I can tell you they're all mismanaged. They all got under market rents, and they're not well taken care of. A lot of times the numbers he gives you don't make any sense, and he's not doing them himself. He hires property managers, but he doesn't manage them. You have to manage your property manager. But he said, "Yeah, I'll sell that one," and then you know, I'm a numbers guy. I said, "All right, what income is it making now?" And because that's the basis uh, on what you buy it for. He says, yes, but it could be making this. I said, well, yeah, but it's not. And so, yeah, so for 3 or 4 years, I've yet to be able to buy one of this guy's properties,
Mhm.
and because he just thinks everything's worth what it could be worth. And I said, I agree, it could be worth that, but it's not today. I said, and I even coach him. I said, I'll help you fix these leases, and I've done this before. I'll sit
Yeah.
down with somebody, and we've waited 3 years for him to be able to fix the leases, and then I'll come back and I'll buy it at that value. So I've sort of coached him just so I can pay a higher price. It seems like, but I do like coaching people in it.
Yeah.
But this guy never wants to fix anything. He just yeah, but just say his average price per square foot is $14, and yeah, but they're getting 18 over there, and say yeah, they are. You're not because your manager's not doing things properly. So if you want to sell it today, it's worth this.
Hmm.
And because you can't pay somebody else for the work that you have to do.
Right.
There's no doubt that I would buy that property and I would get it to 18 and $20 a foot
Hmm.
over time. I'm not going to pay him for that.
Yeah.
I'm the one that got to do that work, and that's hard work. And anyway, so one of these days he'll really be a seller, and hopefully he'll call me and I'll buy these properties because he's got some massively underutilized properties,
Yeah.
that are just being mismanaged. So
Yeah.
that's the frustrating thing. So
Um, well, talking about deals a little bit, what's the best deal that you've ever done? What's the best win that you've ever had, and what made it the best?
well, sometimes you just and you got to walk the properties yourselves. So we got this one last year. It's a medical office building, um, and I'm doing it all. Professional seller's broker, great, great offering memorandum, really detailed, and I was surprised when I walked in and we're touring the basement area, and there's a 3,000 square foot area that all the other tenants are just using for storage. There's windows, there's HVAC, and I'm looking around and it's like, it's a 20,000 square foot building. And I'm like, why isn't this rented? And we all love our doctors because sometimes they'll even save our lives. But let's face it, they're not the best business people in the world. And they just never put it on the market. And so we were already getting a good price for this thing. And sure enough, we got in there and got the storage cleaned out. Gave the tenants plenty of time to take their cherished belongings, that they had uh, put down there, and we put it on the market. And so it was more than 10% of the total building, which they were just ignoring
Yeah.
as an income potential. And so it was just a major home run. We were already under contract, so it was just found money,
Yeah.
if you would. I think I spent $20,000, you know, painting the walls and extending the AC and putting some light fixtures in there, and gobbled it up and rented it for $24 a foot, triple net, and which actually lowered the CAM charges for all the other tenants in the building because there's somebody else there paying,
Yeah.
and so everybody was a winner.
Yeah.
Just like, um, you've just got to look at every property. There was no, and not to pat myself on the back, it's just my perspective. I could have sent my property manager in there 4 or 5 times. It would have never occurred to him. I walked in there and immediately I'm like, why isn't this being rented? And because everybody's got their own perspective.
Hmm.
And so it's that's probably the biggest home run. All of our properties are um, pretty much performing as expected. We've got a couple that are doing far better, and one or two that are doing a little less. For and a lot of those are due to vacancy issues. So we say, I don't do development. I don't do heavy value adds. I don't do floating rate debt. So the only risk that I cannot control is vacancy risk. And so sometimes they that comes along unexpectedly. That's just part of the real estate business. So we aggressively market things and get people in there as quick as we can. So
Yeah. Yeah. Absolutely. But what about the worst deal that you've ever done? I know you mentioned me earlier about hitting the bottom.
yeah, that was back during the great financial crisis, not in our current form. So I was doing a bunch of residential real estate, and there for the several years, 2006, 7, and 8, I was doing all of it by myself with no real equity. Banks were offering really stupid loans, and they'll still do it today. So you've got to discipline yourself. Um, and so we got into 2008, and I had amassed a fair amount of property, but I didn't have any real equity. I'd borrow from this one, refinance this one to get cash to buy this one, and then the whole equity ladder thing, and so just no cash, no reserves whatsoever, and then the merry-go-round stopped. I think old Warren Buffett from Berkshire Hathaway said, "Now we're going to see who's been. The tide's gone out. Now we're going to see who's been swimming without their trunks on." And that was me, figuratively speaking. And I didn't think I needed reserves at the time, and if I'd had reserves of $300 to $500,000, I could have saved a $20 million portfolio,
Hmm.
just to be able to have some carrying power for a year or 18 months. But I didn't. So ended up losing almost all of it. So that's the worst. There was nothing wrong with any one of those particular assets.
Yeah.
It's just that the world stopped.
Hmm.
And when I was going back and talking about interest rate, if there is no debt available, the value of your property drops like a rock.
Hmm.
And people don't necessarily understand that, but credit drives asset values in all kinds of asset classes. And so there was no way for me to borrow against the equity in any of those assets to pull out of that because nobody was lending.
Hmm.
I couldn't have borrowed a dime. So anyway, um, that's uh, that's the worst thing. And I learned all about how to structure a deal properly,
Yeah.
how to have reserves, because I learned that you don't know what you don't know.
Yeah.
Going into any deal, not just a real estate deal, thinking, oh well, I got this locked, nothing can happen. Yeah, it can. You know, um, you know, I don't do single tenant buildings, because of that very reason.
Hmm.
You're less likely to lose all of your tenants in a multi-tenant building, but I don't for a moment think it couldn't happen,
Yeah.
because it could, but you're less likely to. So it's just another version of diversification, and then we carry reserves for you know. I call it the "I don't know what I don't know" reserve. So
Yeah. So diversification and reserves, those were the two big
yes,
lessons learned
yeah,
there.
yeah.
Nice. All right, we're getting out of the I guess specifics of the now and the past. What about the future? Looking forward to the future. Where do you want your company, your business to be in about 18 months?
I don't know that we'll get there in 18 months, but our short-term goal is to get $100 million of assets under management. We're about halfway there now,
Okay.
48.5 million, and with this next acquisition, we'll be well over 50. And so, I mean, we've got to pick up the pace to do that, but I do think we're on a path to acquire as many assets as makes sense according to our rules of acquisition,
Mhm.
but to do it very aggressively, and which means we have to be aggressive at raising capital as well.
Right. Raising capital. So the goal then is, or I guess the subsidiary goal is to raise more capital.
Uh, yes, raise more capital for the purpose of acquiring more assets. Yes.
Right. So then would you say that the biggest bottleneck that you have would be to raise capital?
Yeah, I think that's everybody's bottleneck in this business. So investors get burned, or relationships that you built, they get fully invested and they don't have any more. So you're constantly needing new relationships, and to meet new investors.
Right. Do you see any potential for AI being able to solve that bottleneck, seeing as it's industry wide? If everybody has the issue, why can't we automate or figure out some sort of technological solution to help us solve it?
We are certainly dabbling with three actual AI driven lead generation models. And it, which is just a variation on acquiring a list, if you would. So a lot of these AI models will crawl LinkedIn or crawl the internet and get emails from people that seem to fit the model of accredited investors, and then you start blasting out cold email,
Mhm.
and you can even program the first one or two responses, and sort of monitor it that way. So we've got one deal working like that. We've got some others that are just generating leads, and which we will then put into our regular content generation model. Um, and so we're dabbling with that. no great successes, but I think AI will definitely be a major player in that space, at least of getting connections made. Ultimately, this business is about relationships,
Mhm.
and so AI is not going to really help with that. I
Yeah.
don't think. It might be able to help with some routine investor relations type things, um, but yeah, I'll be the last one to turn AI onto my investors. I'm just big on having a personal touch.
Yeah.
Just help them solve whatever their question is as soon as possible.
Yeah. Absolutely. Well, closing out here, if you had to give some advice to somebody getting into real estate in general, if they were entering the profession, what advice would you give to them?
Uh, Pick a deal, start underwriting it, and if it makes sense, do it. Figure out a way to do it. Um, you know, it will be a little scary, perhaps, but at the end of the day, real estate's simple. How much money does it make? What's the rent? Is that rent market rate? Is it below market? Is it below above market? And what are the four major expenses? Management costs. So don't ever forget to value your own time in managing that property. Maintenance and repairs, insurance, property taxes. These are the four major areas that you got to nail down. And then there'll always be a little bit of administrative cost as well, which you should throw in there. So, and underwrite all those costs as best as you can. And then if it looks like it's positive, figure out a way to do it. And don't be afraid to ask the seller to finance some of it for you. Um, Years and years and years ago, there was this infomercial guy named Carlton Sheets. He was the first guy that ever came out and did no money down, how to get rich with real estate. And he came across very cheesy. Anyway, I bought his course, and darned if it didn't just have some good stuff in it. And the best thing that I still use today is that if you're not embarrassed by your first offer on a piece of property, then you are offering too much. I mean, I cannot tell you countless numbers of times that I've gone in and just said, this is a ridiculous offer. They're going to laugh me out, and I still get embarrassed because sometimes they bite on it, and all they can do is say no. It
Yeah.
doesn't mean you can't come back with another one. So, buying a piece of real estate is just good old fashioned bartering. It is not like Walmart where you pay the sticker price. Um, but you should have a point of view as to what it's after looking at your numbers and figuring out what cap rate does that relate to? What am I paying versus what's in the market? So, my advice to anybody trying to just start doing it. Make Analyze deals and make a lot of offers because unless you're just really lucky, they're not gonna take your first offer, and you're not likely gonna get the deal on the first property. But like exercising, you get your reps in by doing the underwriting and the analysis, and that's what it comes down to. And a basic real estate deal can be analyzed in a relatively short period of time.
Right. Underwrite first. If it makes sense, close the deal. If you're not embarrassed by your first offer, you're doing it wrong.
That's right. That's right.
Awesome. Where can people find you at if they want to find you, Stuart?
Best place to find me is harvardgrace.com. You will be able to find my contact information and a Calendly link there. If you want to, I'll talk to anybody about real estate all day long. So feel free to reach out and book some time. We got a lot of free resources there on the website. And so just knock yourself out. So
Yeah, awesome.
would love to talk to
Thanks.
anybody.
Yeah. Thanks for coming on today, Stuart, and giving us some insight into your operations. And yeah, we especially appreciate the financial side of it, the in-depth financial side of it as a CPA. So yeah, I appreciate it. I always say knowledge is
You
wealth.
bet.
So thanks for spreading your wealth with us today.
My pleasure. Thanks for having me.